Given the current domestic macroeconomic environment, how do you see the outlook for the BFSI sector? Where do you see the key risks and potential opportunities?
Very big picture macro factors such as domestic inflation, crude prices, the US dollar versus the INR, all of these are actually playing out pretty well for India over the past 3 to 6 months. In addition to that, specifically for KCP, if you were to look at two factors which largely drive outperformance for quality financials, number one being differentiation in asset quality, and the second one being easing of liquidity or lowering of interest rates, both of these factors are playing out simultaneously. And therefore, in that backdrop, our stock selection, in addition to these tailwinds, have led to us delivering top quartile performance over the past 12 months. This has also led to our companies growing faster than most of the rest of the players within the industry.
What is your assessment of the current valuations in the BFSI space?
Valuations for quality financials are no longer cheap. We had been advocating a large weight to the likes of HDFC Bank, Kotak Bank, Chola, Bajaj over the last couple of years. However, the pessimism is no longer as acute around these names as it used to be during 2020 to 23. And this change in perception has resulted in massive outperformance of these stocks coupled with a re-rating over the past 6 to 12 months. We believe well-run financial companies should be a part of most broad-based portfolios.
How is the overall portfolio currently positioned? What types of risks are you actively taking and which ones are you avoiding?
Our job remains to keep finding mispriced stocks so as to achieve our long-term objective, which we stated in our last webinar. Most of our companies are well capitalized, have clean balance sheets, and have enough room to accelerate growth as and when the opportunity presents itself. On the capital markets front, which is another area that we like, we've still avoided that zone given the valuation concerns that we have. But again, we will be opportunistic in adding these stocks as soon as valuations correct. On an overall basis, we believe the portfolio is well positioned to deliver on its long-term objectives, given the low single-digit market shares for most of our companies and the long runway for growth for financialization in India. We believe KCP is well positioned for the long term.
How was the business performance of the portfolio companies for the recent quarter ending March?
The latest quarter shows that most of the lenders aren't growing as fast as they were growing before. If we were to see this data from broad economic indicators, the RBI data is now suggesting the loan growth for the sector is down from a peak of about 15-16% to now 11%. In that context, the latest quarter for KCP lenders shows that the loan growth is now down to 15%. Versus the industry, KCP lenders continue to grow at 1.5x the speed of the banking sector. However, the good news is on asset quality. The asset quality turned out to be better than most people feared. The large private sector banks, as we've already shown in data, continue to report very good asset quality. Similarly, large NBFCs like Bajaj and Chola, after reporting a deterioration in asset quality in H1, actually reported very good asset quality in H2. So overall, if I were to sum up, KCP lenders are outperforming on growth as well as asset quality. Some of the trends that we saw in H1 have normalized in H2.
Can you provide insight into the portfolio's earnings growth? Was the growth sustained during the March quarter?
Coming to earnings growth, for the latest quarter, about 75% of KCP companies have reported earnings. The weighted average EPS growth for Q4 stood at about 15%. Of course, this is also slowing down. In the first 9 months, KCP lenders actually grew at about 18%. So to that extent, KCP continues to report outperformance even on PAT growth in the quarter 4. Falling interest rates should actually be beneficial for non-banks, but at the same time, banks would see some margin compression, most of which should be in H1 of FY26. However, we see the risk should be largely on growth, and here are some data points why we think growth could disappoint. If you look at the banking sector growth, it's come off from about 15-16% to 10-11%. Credit card issuance in our country is now only growing at about 7-8%. The general insurance industry is seeing growth in the range of about 0 to 5%. Demat additions and mutual fund flows in the country have now come off from the peak. So broad data points are actually suggesting that there is growth slowdown in the offing.
Which companies or segments are you bullish on for FY26 and why?
In this outlook, we are largely aligning ourselves to stock-specific opportunities. We see stocks like a Home First, which has recently raised capital, should continue to report solid growth. Opportunities like a CMS Info or HDFC Bank. Similarly, microfinance is another area which has seen the worst, and we think from FY26 should see growth coming back and asset quality normalizing. So largely, we continue to remain bottoms up in our approach. We are adding companies with diverse risk backgrounds. In the last 3 to 6 months, we have added companies in gold loan finance space, some companies in the fintech space to our coverage. However, most of them still don't offer us enough margin of safety, hence we have not added them in the portfolio. As and when the stock prices of these stocks correct, we may add them into the portfolio if they offer us enough margin of safety, and we will keep you updated about the same through our periodical publications.